या कुन्देन्दु तुषारहारधवला या शुभ्रवस्त्रावृता या वीणावरदण्डमण्डितकरा या श्वेतपद्मासना या ब्रह्माच्युतशङ्करप्रभृतिभिः देवैः सदा वन्दिता सा मां पातु सरस्वती भगवती निःशेषजाड्यापहा। शुक्लां ब्रह्मविचारसारपरमा आद्यां जगद्व्यापिनीं वीणापुस्तकधारिणीम् अभयदां जाड्यान्धकारापहाम्। हस्ते स्फाटिकमालिकां विदधतीं पद्मासने संस्थितां वन्दे तां परमेश्वरीं भगवतीं बुद्धिप्रदां शारदाम्।
So good morning, friends, and welcome to this session on risk management. It's a subject which is very important for all the bankers, but at the same time, very little understood. Most of the people, they think that somebody else will take care of this job, but ultimately they have to take care of it. And it is very important for, especially for the senior executives, to understand the concepts of risk management. And today we have a speaker, Madam Shashikala Ramachandra, who will be speaking to us on this. Her session is divided into two parts. Session 1 she'll be having today, and the second part of this session will be happening on 27th of November at the same time. And Madam Shashikala is ex-General Manager of Canara Bank and the Chief Risk Officer of Canara Bank. And she has written several articles on risk management and is a known personality in the field of risk management. So now I'll request Madam Shashikala to start her presentation.
So good morning, everyone, and thanks, Mr. Arvind Mohan, for this opportunity and giving me these two sessions, especially on the subject of risk management. So good morning, everybody. I think people are still joining, but I'll just start, isn't it, Mr. Mohan?
Yes, we can start.
So now, as Mr. Mohan said, that I have been asked to handle this session in two parts of 1 hour each. And the request was to cover a subject relative to the IABF curriculum, and quite a task for 2 hours time, but still I have tried to bring in the concepts exhaustively. However, the explanations and the practice, the relative to the practice could be a challenge to cover in 2 hours. Still, I'll make an attempt as much as possible. So what I have done is to focus on key conceptual understanding of the subject with some practical aspects and how this can be integrated into the organization. And the ultimate aim is to have a very healthy and resilient business. So having said that, I will say that there are challenges. Nothing is devoid of that. So when anyone asks me what is the worst challenge that I have faced in risk management, I always tell it has been selling risk management concepts to the business heads and the top management. This is the biggest challenge that a risk manager can have, a CRO can have, because there is always a conflict between the business and the risk, because the thinking from each side is different. So, and of course, I think in this group there are some stalwarts in the from the industry, ex and even current, executive cadres and above that. And for them, this session may appear little basic, so they'll have to, manage with that. And of course, there are some FRMs, I suppose. And for the FRMs who are here, the conceptual understanding of framework may be familiar, but the practicality in Indian banking industry may be little unfamiliar. So, because as I have seen the FRM, the contents, what I understand is it is skewed towards the credit risk related to market risk concepts, and the actual treatment of credit products in Indian banking industry. And no, it is little different, especially how we treat it in the modeling framework. And operational risk also could be little more different in our context. Now, say risk management, it's all encompassing. Every aspect of the banking involves risk management. This is the first thing that we need to understand when we say risk management. And I'll be trying to cover the key features of risk management, the evolution and the basic ones, the credit market and op risk and its concepts, the pillar 1 and pillar 2, if time permits today, or else I'll take it to the next hour, depending on how the flow goes. So, and in the next session, what I propose is to, cover a little about pricing. So pricing in the sense, what is, how it is closely related to risk concepts. That's what I want to cover. And the Basel III reforms and its evolution, why it happened, and the post-crisis reform, that is a forward-looking. So because in post-crisis reforms, a lot of changes have been made, and what is the reason why these changes are coming in? Because I heard that RBI is also going to issue some circular on this reforms shortly, because the deadline is nearing, though shifted to March 23, sorry, 1/1/23, still it is nearing. So better to have some understanding of that. So, and now coming to the basics. So as I said, I will not put too much time on it, but just want to give you a basic idea of what is risk management for those who are initiated. So actually it minimizes the downside risk. So what is minimizing the downside risk is that we anticipate certain riskiness in the business, and by putting in place some measures, some mitigation measures, it can be minimized. And basically by identifying areas of concerns, and to manage this, setting of limits of tolerance, so that we have a point to watch out. If we reach there, we should not breach. So a proactive approach can be taken to manage this. And risk management actually facilitates maximization of reward as against risk. So it's no more cost versus benefit, but it is risk against reward. And balancing this is by the practice of risk management. So we will go a little deeper when we discuss pricing in the next session into this particular aspect. And information exchange among verticals. Verticals are very important, because without information exchange, our risk management will never get a proper understanding of what is happening around. So there is nothing like a confidentiality in the verticals that information will not be given to risk management. So what RM wants is entire gamut of information, because after all, when we say risk management, it is about taking informed decisions. So information is the key raw material. So like, for example, someone says in AML, the information that they're gathering is very confidential and they'll not give it to risk. Risk management cannot do its job, because AML incident, this is one example, simple example that I'm giving. What happens in AML is very important to understand for risk to know whether any policy tweaking is required, process tweaking is required, and what would be the impact. So that is how I'm saying that information exchange is very important. Now, one more thing, like Mr. Mohan was also initially saying, is it only risk management job? And whether it is a static desk job, risk management does the policies and then people will follow it and over, that is done. No, it is a dynamic exercise. It is, this has to watch intraday, every day, keep ears and eyes open, because so many things are happening around in the environment. Anything can come and hit the business. So that is how it is a dynamic exercise, we say, and not a static job. So coming to the, now we said, I said, what is risk management? But okay, what it does not do. Now it cannot, no, you cannot say I have a risk management, so I will avoid future losses, I am robust and everything is fine. We can't say that. So there are no miracles that's going to happen just because you have a risk management in place. And mere compliance and disclosures, even this will not ensure all is well, nor it protects just because transparent disclosures are done and okay, I have done my job, I have told everything, I am fine. That doesn't happen. And it is not a substitute for internal control or internal audit. That we can, that I'll explain further. And it doesn't mean, risk management gathers data, build models, get some outcomes, and there ends. No, actually the process itself is going to give us a lot of learning, and the outcome is going to tell us what is the impact and what action should be taken. So ultimately risk can never be eliminated. That understanding we need to have. It can be only minimized. Never can it be eliminated. There's nothing like elimination of risk. And key features. Now, what are these key features that I want to talk about? Now, prerequisites. What is it that is required? Now you need to have a robust system. What is a robust system? Now we will start from the beginning, from the active board and senior management. That is very important. That is the first step, I would say, that they should be completely aware of the effects of all the impact assessments, whatever is placed to them. They should have the capability to imbibe that, understand that, see the impact, and guide the committee, so that down the line the actual directions will go comprehensively. And risk management is responsible for drawing the policies, procedures, and the processes, and that has to be in tune with the statutory and regulatory requirements. And a robust MIS should be in place. Very important to have a MIS where data plays a very significant role. So without this, risk management cannot function effectively. So that is something that we need to be aware of. So risk, next I'll come to risk governance. So I said that first point is the board and the committee, the risk management committee. So governance structure actually, it is defined by the regulator also. Recently also in April, there's a guideline that has come from RBI on how the risk governance should be in place in every bank and every NBFC. So this guideline is also very clear about it, and even Company Act 2014 has a lot to say about the risk, how the risk management committee should function, and what is its responsibility and role, and what are the strictures if they have not done their job. So that much of importance is given. So in the governance structure, first comes the board of directors, then the audit committee, and then the risk management committee of the board. And now because of these guidelines from the BCBS, which is adopted by the RBI, much importance is given to this. And it is very clearly said that the one who chairs the risk management committee of the board should be a non-executive director, and the committee should comprise of a majority of non-executive directors. So that way the independence of the risk management committee to take decisions is put in place now, and that needs to be carried out by all the banks, and NBFCs also are coming into this ambit. And the rest of the committees that these are all committees, the subcommittees which can be headed by the ED or the MD, and where all the vertical heads sit and discuss and deliberate on key issues of the policies and the processes and the monitoring aspects. So different committees as required by the bank or the NBFC, depending on the scale of operations and the complexity of the business, can be put in place. So what is the risk framework all about? Now it's in simple words. Now it is stated as assess and manage. Now for this to be done, it is very necessary to have an enterprise-wide risk appetite. Now this risk appetite statement again we'll try to discuss further down, but it's that itself is a very bigger subject to tell what all has to be fixed as a risk appetite and all that. But now the risk appetite defined very important because there will be some visibility to monitor the exposures and the capital availability. For anything, capital is required. So it depends. These are all interlinked things: risk appetite, the capital availability, and the proactive action for keeping the business smoothly running is all dependent on this framework. And relevant policies will drive these things, because whatever you define as a risk appetite will come into the policy, and that has to be adhered to. So, and the monitoring the bank's compliance and internal policies is again comes into another gamut of internal audit and compliance, where these things are taken care of for adherence to either regulatory prescriptions or statutory prescriptions or the internal policy prescriptions. So the framework in brief is defined this way. Now, I was telling that internal audit. Now, this is not a substitute. So let us talk about the lines of defense. Now, what is this lines of defense? Now, there are 3 lines of defense actually defined, and then a 4th line was also added. But for this sake, I am just talking about the 3 lines. First line is the frontline soldiers. Now, frontline soldiers are who? The business units, the branches. Now, here is where the onboarding of unwanted risk. They are the ones who talk to the customer, find out whether the KYC is okay, whether worthy of onboarding, whether they can come into the bank as a customer or as a borrower. So we call them the first line of defense. They are actually protecting there. So it's very important the business units realize what is the what is the importance of the KYC, or what is the importance of the credit investigations. All these things has to be taken care there, so that at the initial level itself, it is the whatever unwanted accounts are there, they are avoided from taking into it. So, but then how does this happen? There is a second line of defense. Now, what is the second line of defense going to do? Yes, policies, processes, procedures are defined. It is to be adhered to. So risk management does all this and gives guidance, gives advisory on how where something is going wrong, whether something some needs to be put in place, whether policies are okay, whether processes are faulty, whether the procedures are actually not good enough, that the business units are making some mistakes. This sort of thing is taken care of by risk management. But then that doesn't end there. Risk management also needs to be audited. Someone has to tell that risk management is also doing their job properly. Now, internal audit does it for the business units. Likewise, they are supposed to do it for the risk management also. So here, internal audit comes into a very important position and is called the third line of defense. So see, these lines of defense is actually controlling what is happening in the bank, so that untoward things are getting minimized and also repaired. So that is the main objective of this. So, and now internal audit, that is the reason why even RBI, when they come, they keep saying the audit department should have personnel with expertise in risk management, because without knowing what it is, they will not be able to audit the risk management. Then it will become just a just a show of audit where nothing comes out. You ask the risk management person how you have done it and then write on it, but you do not know what is the faults there or whether something can be improved. That sort of insight the risk management will not be able to get, because it's like I do and I am right. That should not happen. The audit should be very comprehensive and very intelligently they had to go through and try to advise how risk management has failed, and if at all some improvements can be done. That advisory will just help the bank become more resilient. Core risk management framework. So this is something that it's a summation of what I was talking about. The organization structure, governance, policies, procedures, processes. And one thing I have added here is outcome of measuring systems, because models are created in the risk. They develop the models, they validate the models, which are to be validated further by the audit department or the external audit. And what is the main requirement for this under the framework is the systems, the support of robust systems, the data, the capital computation and validation exercises. Here the data, I put it in capitals because that is the key raw material. You may have the system support, you may have people who know how to develop models, everything is in place, but if you don't have good data, nothing is going to work. So this is where you need the support of each and every person in the bank, from the branch level officer who inputs data to the one who checks it, and then the one who actually the officers above him, the controlling officers, they also need to see that the data is complete. So it is at all levels, and the IT of course has a very big role to play, because they are the ones who are going to hold the that huge data with them and get the reports and they get the data that the risk wants, or whichever wants for the MIS ready and clean. So this is something that I'm stressing upon, because without that, no risk management can work effectively. So now let us go back a little to the time machine. Just want to give a little history on why Basel and how it came forward. So that gives us a perspective on why risk management is only talking about Basel and the guidelines and the following of the all these models. So it sometimes, for the person who is initiating, looks very mind-boggling. But there is always a reason behind everything. So, but however, I'm not going back to the story of Herstatt risk and all, because that is, I think, much said around, and everybody is sort of familiar with what that risk was and why it happened. But then that was a starting point, because that was a settlement risk, and that is when the BCBS was formed, and they felt that there should be some sort of a standardization across the globe, so that between the countries the transactions will happen with ease and with little fear of losing money. So that was Basel 1, 1988, and there it was only a definition of capital and a capital measure, and that too it was only for credit risk. So it was the starting point. That starting point did not, it was not satisfying, because there were other risks that has to be taken care of and other events that happened around the globe. So slowly, there is an evolution into the Basel 1, sorry, Basel 2, there's a mistake there. So in 1996, it included market risk. In Basel 1, it included market risk, and this was only for the open positions, the forex transactions that traded debt securities, equities, because these were in the market risk. They found that certain events were happening which was actually harming the banks bottom line and towards the failure. So this is where another evolution happened, and further down there was a lot of committee discussions at BCBS level, and in 2004 we got this new capital adequacy framework. This was considered very comprehensive and robust, and here the 3 pillars concept was introduced. The pillar 1, pillar 2, pillar 3, which we'll discuss further. Next came 2009. What happened in 2008, we all know, the global financial crisis. So after this, the illiquid credit products, the complex transactions that happened on brought down the biggest bank. So after this, there was something to be done on this front also. And so capital requirements specifically for such liquid credit products, the securitizing products, all this was introduced. Then came Basel III. So Basel II was actually, addressing the risk-weighted assets part of it. So when you say CRAR, it's capital over RWA. The RWA was addressed in Basel II. Basel III came to address the numerator part of it. So here the strengthening of bank capital requirements was the focus. And now the post-crisis reforms. Like people may think why they keep on changing these things. Why is it that they can't have some standardization and just follow that? But it's always the evolution is actually a process of correction, and it's dynamic. Things keep happening in the environment, so there can't be any static framework that will be okay for years to come. So this is just a way of strengthening and keep on strengthening the requirement, so that we can also see when the pandemic happened, though so much of disruptions happened in the banking sector and the economy, there is no bank that has failed. So credit can be given to these framework, which actually made the banks more resilient. So when we talk about the post-crisis reform in my second hour session on 27, we will try to understand what exactly is addressed now, that after Basel II of the numerator and denominator, and Basel III of numerator is addressed, what more? That we will see going further. So now Basel II. We will try to understand Basel II in a perspective with keeping in mind the post-crisis reforms. I'm going to talk a little about it, because there's going to be some major changes happening in the post-crisis reform. So some may be redundant and some may be there, but effect could be different. So however, for the sake of completion, and it's actually in where India is, it's better to know what is Basel II also. So Basel II talked about migration to an advanced approaches, and for the capital computation of credit market and op risk. So here now standardization was towards adequacy of capital, and the intention was to make the banks more resilient to any upheavals. So now this is by ensuring that risks are covered by capital. That was the main intention of Basel II. So steps required was to, again, system support, data collation, aggregation of data. This risk aggregation was a very important aspect, because each and every bank had multiple numerous systems where data was in a totally disaggregated format. So getting this data for advanced approaches requirements, the model requirements, was a big challenge. Now all these leading towards computational capabilities, because right amount of capital need to be arrived at. Now this actually entailed a complete transformation. Now transformation of risk management policies, procedures, everything needed to be redone when this was introduced, because additional data fields were required. And this, apart from sensitizing and making the top management understand what this is all about, and making the up to the grassroots employees understand. So this was another big challenge that was posed because of Basel II introduction. Now, the vision was for an enterprise-wide implementation of risk management. So when we say enterprise-wide, here the group concept also came into the picture. So if the bank had the several subsidiaries all put together, the risk management needed to be seen on a holistic basis. So not just the bank and its risk. So it was quite a very wide canvas job that was meant to be under Basel II. So here also again the framework talks about governance and policies. So it is just a refresh of the key requirements. So except that here that there are some additional tasks that are added to those key components. And what are they? The risk identification, assessment, measurement, easily said, but difficult to do. Now, whenever we talk about this, we easily say identify, assess, measure, mitigate. But to do these four, how difficult it is, because everything starts from the process. Now you need to develop a process for how to identify risk, how to assess the risk, and how to measure the risk. And then having done that, you see the outcome and mitigation measures how to put in place. So now this actually was the modeling requirement that came into picture. Now everybody does risk management. The one who is taking a deposit is doing risk management, because KYC is part of risk management, for example. And you see the person who is actually assessing the credit risk is the one who is going to take the papers from the customer and see whether he is credit worthy and do the complete due diligence of the proposal. That is again risk management, assessing what is the risk. And then measurement, we decide on that. Then comes monitoring. Having given the loan, we monitor. So monitoring also is a risk management measure. Then the further processes up to the recovery is all risk management measures. So nothing is out of the ambit of risk management, whatever we do in the bank. So the other aspect of that is added to this component is the risk mitigation and monitoring. So when I said mitigation, yes, you have to identify, assess, measure, how to mitigate. Now, the process of risk mitigation itself is another model. Again, it is a frame to see that people do the job properly for monitoring, and risk limits are set, and an MIS and a reporting structure is created. So in this structure, every data is available, every granular data, so that people can go through that and say what decision needs to be taken, how matters are to be monitored, how what sort of directions should go to the grassroots. These are some practical examples that I'm just highlighting. There are numerous like that, because every risk management, every line in risk management can be linked to the practical banking aspect. However, no, I will not be able to be very thoroughly giving you the examples, but people are free to ask me anything which they want to link it to the practical banking aspects in the QA time. Now, what is further components? Talked about risk reporting. So again, data and relevance, its relevance and the accuracy, very important. And risk reporting dashboard. This dashboard needs to be placed to the top management, at least up to the MD CEO every day, because that's the person who needs to know what is happening. And then, of course, at the periodical intervals to the risk management committee of the board. And technology solutions are very important. Without that, no framework can work in risk. And next comes the capital planning. So why is this such a focus area in capital planning? What has it got to do with risk management? Because planning is done by someone. What is the risk management role? Now, this could no longer, it could not have been some Excel based exercise. Okay, you take an Excel sheet, 20%, whatever, do the budgeting, send it down the line, start coming. Okay, my target is high, my target is not good, I will do that. These things happen. So there should be a system of capital planning. Now, vertical heads responsible they are responsible for business figures. So definitely their focus is different. They want to do the business. But then it is not just a top line saying that, okay, I'll do this much of top line and I will achieve it. That's not capital planning. So capital becomes a key component. So, and business strategy has to be work hand in hand with capital planning. So now to do that sort of a budgeting exercise, it is very important that people sit together, because if there is no proper capital allocation will be the first step. When risk management says this much of capital is required, so have some scenario of what are all the capital requirement for reaching a certain top line, and then sit and discuss. And first we should know whether we can raise so much capital. If so, what is the link there? And profitability comes into picture. So it is a complex exercise that has to be done by the vertical heads sitting together, understanding each other, and trying to understand the risk perception of what the risk management is telling about capital allocation and the extent of sectors and subsectors and the portfolio, the rating grade wise portfolio, to know the quality of the asset. That is very important. So this has to be a risk profiling exercise along with the risk management, the financial management, the planning, and the business units. So all sit together, and then it also needs to be discussed whether capital can be raised, if so at what cost, what is the situation in the market. So all these things has to be taken into consideration, because otherwise what happens is we fix the top line and then the business happens in the last day of the quarter. So that is not going to do good either to the bottom line or to the management of ALM. So it's just a faulty process which can be set right by having a proper capital planning process with all heads put together and in total harmony and coordination. If that is not there, it's going to be a difficult exercise. And independent review. Now, what is this independent review? As I said, models and framework was created by the risk management. Yes, risk management is doing it, but who is going to say that this is correct or not? So internal audit function, which I talked about as a third line of defense in my earlier slide, and the disclosures. Very important is the disclosures, because this is where you have to be accurate and timely, because we are answerable to the stockholders and shareholders of the company. Now, this when I talked about Basel II, I said the 3 pillars concept was introduced. So these are the 3 pillars. So here I'll just go to this slide and tell you what is pillar 1. So pillar 1 is only talking about the minimum standards of management of capital. So the capital adequacy, what is the minimum to be held, is said in Basel II. BCBS say 8%, but RBI has stuck to 9%. That's the minimum standards. Of course, there are some add-ons. The add-ons will come in the Basel III when we talk about the other add-ons. It will be in 11.5 and not 9% as of now. So, and pillar 1 was addressing the capital requirement for credit risk, operation risk, and market risk only. And there was a pillar 2 that was defined as a supervisory review process. Now, what is the supervisory review? Now, having the banks having done certain job, the regulator has an eye on how it is going on. So that is where the regulator steps in as a for the supervisory review and goes thoroughly through the processes of risk profile management, the capital adequacy, whether what has been computed in a pillar 1 is adequate or not. If at all it's not adequate, whether there are other the other risk that has to be evaluated to see that the minimum capital need not be what the bank is keeping, but it can be higher. So our regulator had that authority to say, if you have say 11% capital, no, that's not enough, you have to make it 13, because they made their own risk assessment and review of what is the bank's risk and what is the position there, and it was forward looking. So this supervisory review process is what comes under the ICAP process, which we'll discuss further down. And then pillar 3 was a market discipline. So market discipline, as I said, is about disclosures. And here the approaches of risk management, the adequacy of capital adequacy numbers, and the further analysis of risk exposures, whether it was the asset classification wise or the rating grade wise. So a lot of disclosures have been given which needs to be done so that the shareholders and the stakeholders know what is the risk management process in the bank and whether it is adequate, to know whether the strength of the bank is good and whether there is resilience for the forward looking whatever may come across, whether the bank can stay strong. Formula was given, as I said, capital over RWA, and which was given a capital ratio. And the RWA was only for the 3 key risks of credit, often market risk. So pillar 1 components. This is where credit risk. This definitions, I think you are all familiar with it. Credit risk defined as potential that a borrower or counterparty will fail to meet its obligations. And market risk, again, risk of losses on and off balance sheet positions. And that is mainly because of how the market moves. And op risk, again, resulting from inadequate, failed internal process, people and systems, and or the external events. This again will go further down when we discuss individually about that. Now here, actually capital structure and the components and all, we'll have a deeper discussion in my next session when we talk about Basel III, because as I said, Basel III actually, it is talking about the capital part of the ratio itself, on how capital should be robust. So, but here still, for the sake of completion of this particular and now in Basel II system, I'm just adding some 2 slides. So tier 1, you can see that whatever is in tier 1 is something that will remain in the system, come what may. So even here, the IPDS that we are talking about, earlier there were no stipulations, but now we say Basel approved. Now Basel III approved instruments. So because non-perpetual, now earlier it was not perpetual, but now it is it is actually a regulation that it has to be a perpetual debt instrument to qualify under additional tier 1, which was a Basel III addition that came into picture. Now tier 2 is something that it may not stay and it's fluctuating. So can't depend much on the tier 2 capital to say that it'll always be remaining, and strength will be there, because you see if it is a revaluation reserve was a hybrid instrument or a subordinated debt, these are all little fluid and not such a strong capital that one can have. And deductions from capital, so anyone who is doing the financial analysis knows about it. So these are something that doesn't make sense to have as a capital. So it is all coming into the deduction to arrive at the actual core capital available to say what is the strength of the bank to meet the unexpected losses. So coming to the core credit risk. Now, what is this credit risk? As a definition we saw, but then I'm just giving a few examples of what is contributing to the credit risk. I don't say it is exhaustive, but just to know what is the source of this credit risk. I'll just put these few points. So how does credit risk arise? Now, through direct lending, non-repayment, which we all know, definitely it goes bad. And what about treasury defaults by the counterparties? This again impacts because crystallization happens. And securities trading business, again any crystallization of the asset will amount to it becoming an NPA and a bad debt, and it's a source of credit risk. And what about guarantees and letter of credit? We all know how crystallization of any non-fund liability can come into bad debt, cross-border exposures, and the credit quality, incipiently deteriorating assets. In fact, now the RBI has issued a fresh guideline on the income recognition norms. So here again, some stringent action has been taken. So the credit quality, I think the banks will have to face a little more difficulty in ensuring that there's nothing like, okay, we recover the critical amount and say, yes, I have upgraded the account. That can't happen anymore. So that is something very, yesterday I just saw I was reading through that. So that is something in addition to all this riskiness that the risk management is going to evaluate. Arvind, it's not moving.
It is at your end.
Yeah, I know, but I don't know the reason.
You can restart
Okay.
this presentation.
No, I got it.
I got it.
Yeah. So pillar 1, credit risk. Now approaches is what I want to explain. So now I was talking about now the introduction of Basel II. They had some very comprehensive committee discussions where they decided that there can be some different approaches for different geographies depending on the complexity of the banking industry there and the complexity that is arising in each banking space in different geographies. So based on that, the committee decided on certain different approaches of credit risk for arriving at the capital adequacy. The first one, the more simpler one, was the standardized approach. So in standardized approach, it is like everything is given. So the RWA, the risk-weighted assets, that is knowing how risky is the asset. They have actually taken data from different geographies and arrived at certain percentages of riskiness. So calculate RWA for the banking book. This was given, and even for market risk, the certain risk RWAs were given. So the banks had to just apply these RWAs to arrive at the capital requirement. And here the main focus was using the external ratings. So external ratings, based on that, the RWA could be fixed, like what was for a AAA, what was for a AA, or a retail portfolio, which will go further and see that. So this, in comparison, if we take there are some approaches here, the capital charge was expected to be little higher, but the risk sensitivity was to be little lower. So the reason is that here it is like one size fits all approach, because here when you say a bucket of portfolio is applied the same RWA without knowing whether the independent contracts that are within the portfolio are good or varying degree of goodness and of the asset quality. And then there was another approach of what they called as advanced approaches. Here they brought in again two types. So internal rating based approach, they called it IRB. So as it says here, external rating was not the factor, internal rating became the factor. And they also had some risk measures, how to compute the PD, LGD, and EAD. These factors came into being: the probability of default, loss given default, and exposure at default. Of course, in my talks, I am not going deep in depth into the modeling part of it, because that is quite a different topic by itself, which cannot be covered in this time. So under the advanced approaches, there are two approaches: the FIRB, the foundation internal rating based approach, where PD is measured internally with the internal ratings that the bank has, and LGD and EAD are provided by the regulator. So whatever they say has to be applied. And there was another AIRB, advanced internal rating based approach, where PD, LGD, and EAD, all the three were modeled by the bank, and the risk measures arrived at and then used for the computation of capital. So now if we go here, now AIRB had the lowest capital charge as per the what you say, the sampling that they had done and the exercise that they had done. AIRB had the lowest capital charge, but risk sensitivity was very high because the PD, LGD, EAD were at the account level. So each account could be assessed and how risky it was. And then coming to FIRB, it was little a little higher capital charge than the AIRB, but risk sensitivity was little lower than the AIRB. And for standardized, it was higher capital charge and low risk sensitivity. That is how this approaches were actually brought into picture. Now, the standardized approach for credit risk. So there we had certain asset categories. So these asset categories were given different RWs. Like the sovereigns, there was a zero risk weight. The banks had based on a certain rating criteria. Then the corporates, the PSEs, again the external rating. Commercial real estate, they said 100%. Residential real estate, again there was a 75%, and based on the LTV, lot of dimensions were brought into giving the RWs here. Regulatory retail, again 75% they said, but for personal loans they said 100%. And like this, the different asset categories were having different RWs given by the regulator. Anybody has a question? No? Okay.
Actually, madam, the questions will be coming in the QA session.
Okay. No, there
And,
was a change in the photograph. I thought someone wanted to talk.
No,
That's
no.
why I asked.
And members are requested to, there is a menu option for raising hand. From there, they can raise their hand, and I will come to know that they want to ask a question, so that I can put them on screen one by one to ask the question. Or
Okay.
they can send a message to me that they want to ask a question. Please continue, ma'am.
Okay. So this was the asset categorization that was done for the standardized approach for credit risk. So the banks have all these sectors. So in these segments, the RWAs were to be applied. But however, like when you practically do it, it was not just as easy as this, because the data had to flow from the CBS, and then that asset categorization has to be done. The flags has to be put into the core banking. So system support was required to actually apply for each and every contract. So this was what was the challenge that the banks faced initially, until of course it was overcome and the systems were in place and we were getting the RWAs out of the system. So, and then the off-balance sheet exposures were also part of it, because here actually, though it is off-balance sheet, certain, actually conversion factors were given by the regulator, which had to be applied. And post applying the credit conversion factor on the off-balance sheet exposure, the capital had to be computed. So this was something that the standardized approach gave in the complexity. And this system will remain with some tweaking, of course, of the RWAs in the post-crisis reform. But there are going to be some changes in this approach also. And the key concepts here was the fixing of supervisory risk weights, one size fits all, which, as I said, and the total reliance on external ratings. So, but we all know what happened to the external ratings. We have, most of us have experienced the impact of and its integrity in some of the bad cases that we have come across. So whether such a confidence in external rating was okay was the question that actually came into the discussion after the when the post-crisis reforms were being drawn. As I said, it was a continual improvement. And one more thing about standardized approach was, like you get the RW and apply it and arrive at the capital. But there is no learning there, because you are just applying what if they say 20%, you give 20% RWA. But then there was no learning, because the quality of risk was sort of determined before any learning can happen. So you are, as a bank, we were not able to know. The most we could do was optimization exercise. So when in optimization, the bank could only decide on rebalancing the portfolio, churning the rating grade wise portfolio. That's the only thing that I can do. But there was no question of learning how each asset fared and what could be done for for improving the asset quality, and what factors were contributing it. These were not known in the standardized approach. And credit risk mitigants again was very limited to the liquid ones like cash, gold, and the government guarantee, which was taken for netting of the exposure. Now coming to the next approach of FIRB. Now in India, of course, none of the banks are approved for FIRB or AIRB. Of course, some are doing the parallel run. But however, just for a limited understanding, until we get into the post-crisis reforms, this remains. So I'll just talk briefly about it. So estimates of PD, as I said, is computed by the bank. So for this rating and 1 year performance period. So totally 6 years of information where the PD could be modeled by the bank. And this was to be done for other than the regulatory retail portfolio. So this was a large exercise that the bank started doing, because when Basel II was introduced, none of the banks had such a internal rating system which could actually give sufficient information and data for a probability of default. And because the data that is required was quite huge, and the categorization was different, and the subcategories had to be done. The portfolio had to be split. So there were a lot of challenges which some of the banks have overcome to arrive at the PD. And as I said, LGD and EAD is provided by the regulator depending on whether it is secured or unsecured, and if it is secured, by what quality of mitigant it is secured, whether it is a physical collateral, whether it is financial collateral. So this sort of segregated, LGD and EAD is given by the regulator. And this process was based on expected and unexpected loss, which is used in capital computation, which I'll discuss further. And this said to be more risk sensitive. And internal estimates, again, are to be audited by the internal audit department. And under the supervisory review, the regulator was to come and see whether this was okay. There was to be a thorough validation exercise that the regulator also does, to say that the banks are okay using what was modeled in the bank. So the other approach was a more advanced approach, where they said this sensitivity was high and capital charge was lower. Actually, this itself was the crux of the issue for the post-crisis reforms to come, because when here they claim that it is low capital charge and high risk sensitivity, it actually didn't work out that way. So we'll discuss it along with the post-crisis reforms and the need for such a modification to come. But just for a limited understanding, because currently some banks are doing it, and currently this is still there. Unless RBI issues the guidelines on post-crisis reforms, I have added this. So here, as I said, PD, LGD, EAD, all the risk measures are computed by the bank. Data requirement is just huge. In fact, we had counted something like some 1,500 odd fields that was required for these three computations. So it is that sort of a data, and that has to come out clean, that has to be complete. That was the worst challenge that we have faced and tried to overcome, because the core banking cannot hold every data that you need for risk management. So there has to be some alternate solution to see that what is required, especially in the LGD. The need for data is so huge, and none of us had it at that level. So that was a challenge that was to be overcome. And then again, here also the process is based on expected and unexpected losses for computation of capital. So here the capital is computed, and then the RWA. This is different from standardized approach, where we compute the RWA, then the capital. And this is completely based on internal estimates. So recognizing credit risk mitigants was another challenge here, because as against standardized approach, in advanced approaches, the mitigants were allowed to be used other than cash, gold, and the government guarantee. But they put a lot of conditions on the legal and operational requirement. So we will see what it is in the next one. Before that, I just wanted this slide I have taken from the BCBS paper itself, which was a initial paper issued by BCBS, had this diagram, and it's the simplest diagram where we can try to understand what is an expected loss, what is unexpected loss, and how the tail risk comes. So here you see the EL part of it. Banks make provisions. Each and every loan provision is made by the bank. For NPS, provision is made by the bank. Now what is that? Now you are expecting a loss and providing as a provision. So I've already set aside some amount. So the bank set aside some amount as an expected loss ab initio, and this is already there, available. But what is this unexpected loss and how it is to be covered? Now, this is where these approaches are coming into picture. So what BCBS says is, yes, you are expecting a loss, fine, but is that enough? So when actual modeling was done in this normal distribution, the UL part of it is found uncovered. And how does that get covered is by capital. So the capital adequacy that we are repeatedly talking about is actually addressing the portion of unexpected loss which has to be held as capital, so that when something untoward happens, you have enough capital to absorb those losses and still be in business. That was the idea. But so far as the potential loss, that is the tail, that is concerned, the banks were not expected to keep the capital for that. But as a part of the pillar 2, stress testing had to be done to know what is the stress that and what sort of a capital can be required for stress. That was called the stress capital to cover the tail risk. For this, it was not necessary to keep the capital, but there should be some way of meeting that contingency if at all it arises. So that is how, but in fact, in some European banks, they were asked to keep even stress capital. So for some of the banks, they found that were not resilient, the capital charge, the CRAR, was even up to some 28-29% also initially when this was introduced. So thankfully, in RBI has not asked us to do it. Of course, none of us has the capacity to keep a stress capital, but EL and UL, certainly all the banks have been keeping. And those who couldn't, we are all aware of what are the PCA norms, what happened, and how government had to come to the rescue and pump in money to see that the minimum capital requirement was held by the banks. So that is about the EL and UL in brief. So if you go for the modeling, it is very complex, but to understand the concept, this is sufficient. So now talking about, like I mentioned, a lot of what sounds like a jargon, the probability of default. So to know what it is just a simple thing. Actually, the acronym itself is going to tell you probability of a default. So what is the likelihood that loan will not be repaid and fall into a default? So that is a modeling done for the PD, and it is in the number of borrowers, and it's not based on the amount. So out of 100 borrowers, how many may go into default? That sort of very complex exercise is done to arrive at the PD. And the loss given default, again it explains what is the loss when a default happens. So in English, yes, it is very simple, but to arrive at what is the, you need to know a lot of information, and you also need to know what is the mitigants available, whether there was any security held, whether they could be sold and they could be appropriated to reduce the exposure. No, all these, and what was the facility rating also is a offshoot of this, to know which facility has what sort of security, collateral security, and that collateral security behavior has to be modeled to know what sort of recovery was made of a particular category of collateral, whether it was land and building, whether it was a vehicle. So that sort of modeling has to be done to know each security what is robust and whether recovery was substantial, or if not, what could be the LGD. Next was the exposure at default. Now exposure again, in simple terms, yes, there's a liability in the book and that's the exposure. But this is exposure at default. So when we are modeling, we need to know when a default happens, where the exposure will go. So this is again modeling that was done based on categories, subcategories, the different portfolios, to understand what sort of crystallization can happen. So because if exposure is on the date of NPA is say X rupees, it may not be just X rupees, because if you see the behavior, generally, when it's tending towards default, the exposure, increases, maybe due to give an ad hoc, such things happen. And in off-balance sheet exposure, crystallization is a general thing that happens. So there's a different modeling for off-balance sheet and on-balance sheet exposures, where exposure default is arrived at, and then the maturity. So maturity again it was when BCBS, as a committee, they sat and decided on the maturity, the remaining effective maturity years, the forward-looking years of any loan. It was decided to be 2.5. There is no scientific, way of how they have arrived at 2.5. Nowhere it is on record by BCBS, but they said 2.5 years. So that is taken. But however, if you see the Indian conditions here, the type of recovery that we make, it is never only 2.5 years. It goes up to 5 years, 10 years also. But now maybe things are improving because of the NCLT process, hopefully. So, and what was another major change in Basel II is the definition of default. So when somebody asks us what is default to a banker, we say NPA. NPA is a default. But in the Basel guidelines, it is not just the NPA. If you restructure, it's a default. This was actually internationally followed by all the banks outside India to say that restructure is a default. But in India, we were not. So slowly RBI introduced us to this concept also, and all restructured accounts are to be treated as default accounts. And there was one more category they asked us to say, and that was called as unlikeliness to pay. You may have a very good account, but is it tending towards a default? That was something that we were supposed to look into. So any triggers. So here are some triggers that is stated here: non-accrued status, and account-specific provision due to decline in credit quality, which can be observed by seeing the behavior of the account and the payment pattern. It may not, payment may not be regular. He may pay 1 month, again 2 months he will not pay, again third month he may pay one. It sort of, we called it incipient sickness. That incipient sickness will have to be treated as default. Now, given the latest circular of RBI, I'm not sure, but they may insist on adding that as a default. Right now, banks were not clearly doing it, except in case of the fourth instance, that is filed for bankruptcy, which if it happens. So this is again a summing up what is required. Robust rating system design, because when we say we had to depend on internal rating for capital computation, it's very important to have a robust rating system. So it cannot just, I just have some internal rating and it is okay. That had to be validated to know that the system internal rating is actually throwing up results to say that a particular account is going to default. So that sort of rating grade we had to see, and system support has to be there for risk rating. Some sort of review of rating has to be done at a quarterly interval. And corporate governance, again, it comes everywhere, because every rating system also has to be, some oversight should be there. And this is because this is the main raw material for the PD, which is actually a largest factor for computation of capital. So now we talked about the asset categorization under standard. So even in IRB asset classes, the corporate class asset categorization was a little different, in the sense that they made it more granular. In fact, to look at it, looks like there are less number, but actually it was granular because of the categories and subcategories. And the one specially introduced category was SME. So whatever SME characteristics, they wanted that to be a different category, because when you see, if you see a modeling of the PD and LGD for SME, you will realize how different they behave from the large corporate exposure. So these are the categories that IRB asset classes also talked about. And now retail exposures, again, they gave some criteria. Now this criteria will also undergo a change under the post-crisis reform. But as I said, I repeat again, since we are still here, we'll just talk about it briefly. So here the main thing is now the low value exposure. Other things you can understand. And in low value exposure, earlier it was like the aggregate exposure to one counterparty should not exceed 5 crores. But recently, after the pandemic, when certain BCBS also allowed some dilutions, and actually the actual BCBS circular says that it should be more than 1 million euro. So going by the euro conversion, it will be very high, but still RBI took a decision to increase the threshold from 5 crores to 7.5 crores. That's the only change that immediately that has happened. So now what is the equity exposure? Now we all know what is equities. So this comes under again IRB asset class. So any equity exposure should be irredeemable because it is just we buy and sell. We can't go to the company and say take back your share unless they ask us to sell. There's no obligation and part of the issuer. The issuer you cannot tell the issuer I have brought your share, now it's the rate is you have to buy. Nobody can say that. And it conveys a residual claim on assets or income of issuer. So there's no priority in the equity shares that we hold. So this equity exposure, the modeling was again different. Of course, in standardized, it was given RWA, but later there are certain methodologies for computation of market risk. Then other exposures, it didn't, and any other category. So these are main asset classes were these. Now minimum requirement, when we will talk about risk quantification. So now there are approved collaterals, as I said, there are specific collaterals approved by Basel II. And now not just, now that was, as I said, approved, it was the liquid securities, but here they allowed certain other collaterals subject to certain conditions. Now we will just see what are these. Now CRE and RRE as collateral. Now here the commercial real estate and residential real estate, these can be taken as collateral for our loans whenever we give. So, but the only condition was risk of the borrower is dependent on the underlying capacity of the borrower to repay the debt from other sources. Then eligible financial receivables. We all know what are financial receivables: original maturity less than or equal to 1 year, and physical collateral. So these all could be taken as collateral security and subject to certain conditions accepted as Basel approved collateral for the purpose of arriving at IRB risk measures. Now, what are these requirements? They said whatever security that you take, there should be legal certainty that is enforceable. So there can't be any ambiguity on this aspect, and enforceability is the criteria should be certainly available, and frequent revaluation should be done, because any value difference in value, whether it is increasing or decreasing, whatever, it is going to affect the netting. So netting of the exposure measure and the haircuts. So that is something stipulated. And objective market value for the collateral. This is a common sense value that yes, any collateral that we take should be marketable. And there should be available market. Somebody should be ready to buy. Of course, we all have experienced that whenever we go to buy, sell some collateral for our loans, the distress value, how it goes down. But there should be a market. So the haircut takes care of whatever the reduction in value that can happen. And there should be a first claim. There can't be a second pari passu charge, third pari passu charge, that sort of thing doesn't work. They should have the first independent charge to claim if the account goes bad. And the robust risk management process understood, and low correlation with exposure. Now it is quantification. So for guarantees, what was the treatment that the guidelines said? So where guaranteed, either in support of individual exposure or a pool of exposures. Now, what is this guaranteed? Now, a pool of now guarantees we have seen comes in different forms. One is something that you take individually as from a guarantor. The other one could be there is a government guarantee that is happening. So these all have a risk reducing effect of for the purpose of risk measure. So that's the minimum requirement is that it should be irrevocable guarantee. So like even if suppose this larger exposure, they give something like a sponsor support. So there should not be any revocability clause in that agreement. Only such ones can be taken. And when both the borrowers and guarantors must be assigned a rating, and there is one more provision given in the Basel guidelines that if the external rating of the guarantor is better than the borrower, that can be applied. But again, they are subject to certain conditions of irrevocability and the strength of the guarantor. The guarantee must be in writing, non-cancellable. That's the irrevocability that I was talking about. And only subject to this, the borrower grades can be adjusted for the purpose of arriving at the risk measures. And just because there is a guarantee, it cannot be taken. That's the minimum requirement as stipulated under the Basel guidelines. So now that was about briefly about the credit risk. Mohan, I have time now.
You can continue, no problem.
Because no, if at all, no, it's okay. You tell me, I'll shift it to the next session in case I stop at some point.
Because to maintain continuity, I think we should cover this topic in this session.
Maybe operation and market risk I'll complete, and maybe for the pillar 2 I can move it to next session. If
yes,
you feel,
yes. It's up to you.
No, and the listeners also should have the patience to sit through, because
yes,
shouldn't be like their attention span shouldn't go down. That's what the reason.
So I think the types of risk we can cover in this.
Okay.
And the other part we can shift to the pricing. Along with pricing, we can consider.
And maybe then another 10 minutes I'll just.
Yes, please.
Because there's now going to the operational risk. So the definition remains resulting from inadequate or failed internal processes, people, systems, external events. But here again, there are 3 approaches given. But as I said, the post-crisis reforms is going to make a very big change in this. Right now, the banks are using the basic indicator approach, where the operation risk capital is based on the gross revenue. So like if you have a loss, then you need not keep capital, which is actually not the right thing to do. But the approach is like that, and the model that the BCB is given is like that. And I will not be discussing about advanced measurement approach because that's no more relevant. However, the standardized approach has been revised. Now, standardized approach was actually, based on the gross. Now, it was a sort of, next level to basic indicator approach, where gross revenue was taken in basic indicator as a whole. Here in standardized approach, the gross revenue was taken differently for business lines, and a certain factor was given to arrive at the capital requirements, the RWA. So, but this model again has been modified to add one more component of loss distribution. So there's going to be a change here, which I'll discuss in the post-crisis reforms. And this is just for you all to know what are the type of business lines and loss events that is relevant to the standardized approach for filling up these, matrix. And this actually internal loss data is, as I said, relevant even in the post-crisis reforms, revised operational risk standardized approach. So here again, the identification of loss events. And this, I'll go to the next slide where I have given the details. And external loss data is not relevant as of now, but for the sake of monitoring or for the sake of knowing what is happening in the outside world, I mean, as a risk, risk management person, I would suggest that you do it. But of course, it's left to the independent, view of the bankers. Now, last data, as I said, is still relevant for the standardized approach. So here, there is a lot of work to be done and lot of data to be collected. So it's again a big challenge, and some banks are already doing it. So here, date of occurrence of a certain event, so many events keep happening at the branch level or the controlling office level, the IT department, wherever. Everywhere, such certain operational risk events keep happening. So that is to be collated. So each and every person has to report it in a certain format. System support is required, and that is going to be taken, and certain a sort of root cause analysis is done to know how such an event happened, why it happened, what was the mitigation measures, and whether certain it qualifies for tweaking the processes, what are some of the business process re-engineering concerns, or should it go there. That sort of decisions have to be taken. So the financial loss has to be estimated, and then allocation has to be done based on the, like, because a branch has a different types of business going on, a corporate business, retail business, SME business, deposits. So allocation of loss to whichever business line has to be done to know which business line is actually attracting such a loss. And the recovery, of course, when you said mitigation and off risk, it is generally the insurance that is done. So whether you have the cyber insurance or, and so many insurance policies are there. So if there's a fire happening, the fire insurance will be there. So that sort of netting can be done as a mitigant, whatever insurance that's available. So the level of risk is computed, likelihood into impact. So likelihood of occurrence based on the number of occurrence, and the impact, the loss impact that such an event is bringing into the bank. So that computation will give some view on the operation risk quantified loss. So coming to the market risk, again, market risk, the definition I have gone through. So there are three main components that we can talk about in the market risk, and the interest rate risk, the equity risk, and the foreign exchange rate risk. These are the main ones that contribute to market risk, and there are certain modeling done for computation of these risks also, finally to arrive at the capital charge. And this, the computation in market risk, again, under the post-crisis reforms, it's going to undergo a very major change. So what they call as the FRTB. And so again, that we will discuss in the next session briefly, because it is quite a complex modeling that is done for FRTB, and many of them are still struggling to even understand the particular process, because there are a lot of ifs, buts, and question marks that is happening in that particular guideline. But as of now, what banks are doing is the standardized approach. So any other method that was actually suggested in under the Basel II guidelines are now redundant. So standardized approach, there was two separate charges that were calculated: the specific charge for the issuer risk and the general charge for the systemic risk. So this is briefly about market risk, because it's totally undergoing a change. I'm not going deeper into this one. And the liquidity risk. So this is again part of the market risk. So here interest rate risk in the banking book and liquidity risk are computed. So the interest rate risk, it is adverse movements in interest rates. We know how the interest rates move and what sort of impact that can have on the bottom line. So bank earnings can be affected by this movement, depending on whether it is the interest rates are moving downward or upward as the RBI tweaks. Our portfolio has to be seen into what is the effect on the bank's portfolio, and certain decisions will have to be taken to see that there is no negative impact out of this. So change in the net interest income and interest sensitive income is something that we have to keep a watch upon to see that this risk is minimal. And liquidity risk, this is again the bank's capacity to fund the increase in assets. So both expected and unexpected, cash flows can be there, and the banks have to be prepared for this. So again, ALM is a much deeper subject where it can be, different learning. So here I am just giving you a flavor of it because it has its own complexity and its own time required to understand the ALM concept. Now this is a pillar 2, which I'm going to move to the next session. This is about the ICAP. So the pillar 2 and pillar 3, your disclosures will move it along with the Basel 3. I'll cover it so that first we can go through the Basel 3 norms and then go to the pillar 2 and pillar 3, which is quite relevant even in the Basel 3. So that way I'll be covering, and then lastly the post-crisis reforms in the next session. So thank you all for the patiently listening to this. Hope I have made some sense. Thank you, Mr. Arvind Mohan.
Thank you, ma'am, for this very nice session we had, although it is very much theoretical and participants may have had some problems understanding some of the concepts.
They are free to contact me anytime.
Yes, they can contact you, and at the same time, they will be getting the video of this session, and they may go through this video. I think they may have to go through it at least 2-3 times to understand the concepts fully. And of course, any questions you have, you can ask right now. Also, you can ask your questions, and you can mail them later on as well. And
I don't mind having a separate Q&A session also, because I am very sure that
right
for
now
those
also
who are initiated, it would be difficult. So I just leave it to the audience to.
Yes, but at the moment, whatever questions are there, participants can ask the questions right away. So I request the audience to come out with their questions, whatever questions they have on whatever is covered today. No questions are coming. I think people will need some time to understand the whole thing.
So there are only two things. They haven't understood anything, or they have understood everything.
Maybe there is one hand raised. Mr. Johnny Prince, please switch on your video and ask your question. Please unmute yourself. Mr. Prince, please unmute yourself.
Yes.
Now.
Yes. Right. Good morning, sir. Good morning, ma'am. Basically, my doubt is regarding Basel III guidelines, in which there is a provision that capital, normally for calculation of Tier 1 funds, capital of the preceding year has to be considered. But during the interim period, if there is some kind of capital induction, then it is we can consider it under Tier 1. I have seen this guideline, whether the same thing will be applicable in case of profits also accrued, ma'am.
No, for the profits accrued during the quarter, it's not allowed, because it's after limited audit that happens in the quarter end. And how it pans out in the year end, nobody knows. So it can't be taken sacrosanct, the profits at the quarter end.
Right. Okay. Fine. This actually, I just wanted to know, because one of my colleagues were they had this doubt, so that's the thing.
It's not
right.
allowed.
Thank you.
Yeah.
Thank you.
Any more questions? Rahul sir, आप कुछ कहना चाहते हैं?
Yeah.
Just a minute.
Yeah, madam. Namaskar.
Namaste.
Yeah.
He's my colleague, old colleague. I am old. Yes. He was a colleague.
I'm proud that you could able to hear you, and again that is a learning from now. And I much indebted and to you, having worked with you also, and you have been a doyen in the risk management. I know there is lot of learning which can take place for all of us in the risk management. This is one area where much is read but less is understood, I believe, and this is where we have to. As I have closely interacted with the department, and because we are working in the planning department, and Madam was in risk management, but there is a lot of learning which we have acquired because of this process only. Because as you do it, you learn. But theoretical, okay, this is one part of it. We have to know this, but the much important part of the learning which takes place while doing it. So I believe always, this was has enriched all of us in one aspect of it. I would rather put it in this way, that the importance of risk management in business planning. Because if you think that business planning, the management always puts the accelerator to do more business. So I take business as the management perspective to overspeed, go at more than 100 speed, but while the risk management comes in and it puts a brake. But it's always a fine balance which has always taken place in for the benefit of the organization, because we know that always the risk measurement or the quantifying the risk is always a gray area. Whatever we quantify, may not be enough for this. So that is always a room for extra risk. So in that aspect, business planning has to learn a lot in how to keep the portfolio safe for the organization. So we have learned a lot in this, because this is a process, ICA process, where we need to take into account the capital, available capital, and the within the risks, what is there in the capital, and also the plan for capital for the business growth. Always, while planning the growth, it is not the arithmetic which takes into the place. As Madam has rightly said, that it is not the Excel sheet. Though I am frankly speaking that the most of the planning process takes place in the Excel sheet. So this is nowhere we are doing a big mistake in quantifying the risks. Because as we are involved in planning for the capital, we have to plan for the NPA. That also, because that is as a process. But when you do the planning for the NPA, nobody has any answer for this. So where we makes again a mistake. And Excel planning for the business growth also we make a mistake, because the scenario understanding is completely as you take it does not may not appear to be so in what you go forward. So like that we have learned a lot in this process, because capital, risk management, and the business planning and the profit planning go hand in hand. So I am very much thankful to Madam as my mentor and my guru also. So we have taken a threadbare analysis of these things, but nowhere, I am frankly speaking, nowhere we meet the excellent with the standard which we could have reached. Thank you again, Madam. I know it was a pleasure to listen to you. I will again attend to your next class with the, this one, with the all sincerity and devotion. Thank you.
Some of the issues you raised will actually gave rise to the post-crisis reforms. That's how we have actually decoded that. And of course, the pains that we went through, I still remember. Because as I said in the beginning, it's very difficult to sell risk management in the bank to other vertical heads, and there's always the tension between the two. And actually, to quote one instance, when I was traveling with my ED Bharti madam, we met Mr. Mundra in the airport lounge. So while discussing, he was asking about our risk management, and then. And after explaining, I just made a comment saying, I'm the most hated person as a CRO in the bank. So he laughed and he said, the more you are hated, that means you are doing a good job. So that was what he said. So that is a job of the risk manager, because when things are positive, you are not going to go and tell them, everything is fine, go ahead. No, we don't say, but we find something, we just try to go and tell them, yes, something is going wrong, it needs to be taken care. But that appreciation from the vertical head or the top management, I was even quoting just before we started, one of the CEOs refused to talk to risk management. He said, I don't want any negative people around me because that makes me feel negative. So that was a terminology given to us. But probably as years pass, the understanding is improving, I feel, but still a lot needs to be done at the top management level to appreciate the efforts of risk management and whatever, the outcomes and the impact that we place to them, so that better decision making can be made. That's how I see it. Thank you, Sahu.
Thank you, madam. Thank you, madam.
Thanks,
again.
Dr. Sahu. There is another attendee who is on the screen. Please ask your question and also please introduce yourself because your name is not displayed.
Arvind sir, I want to ask this one.
Yes.
Namaskar, ma'am. It was a very nice presentation on your part. I want to ask one question: whether any limit has been decided by the Reserve Bank to charge capital based upon the limit or on the basis of internal rating or external rating?
No, limit in the sense, I didn't get your, can you just
I want to ask, suppose some credit exposure is there. Is there any limit on behalf of Reserve Bank that we should charge it capital on the basis of external rating, or we can charge it on the basis of internal rating, which some banks do?
No, there's nothing like a limit. It depends on what approaches that you are following. So if you are following an IRB approach, of course, limit in the sense what they said initially in the IRB guidelines was that 85% of the portfolio should be covered under the IRB guidelines. The remaining 15% you are allowed to keep it out. But what you will keep it out of the guideline was, they had given something like the sovereign exposures and some such things. So you need to, you had to justify why you are keeping out into the 15%. That is the limit that they had given. Apart from that, I don't see any such limit. Mr. Shastri, can you add anything to that?
Yes.
Ma'am, I just want to get clarification that we ask parties to get their account accelerated. Whether it is a requirement for action rating for the capital charge based upon the limit, be it 5 crore, 25 crore.
Above 5 crores is what external rating.
External then you say that on based upon the advanced internal rating based, the capital charges to be can be done. Then why there is need for external rating?
No, there are two things. Now there is a difference between the process of internal rating and the process of external rating. You are no doubt doing an internal rating for the purpose of your PD measures. That is one part. But then your external rating needs to be a factor in your internal rating also. And one more thing, now your internal rating is something like a point in time, whereas external rating are more skewed towards what do you say? I'm not getting the words that I mean. It is like historical data is available. Sorry.
TOT through the cycle.
So that is the reason external rating is necessary. And the external rating agency has a visibility of the external environment completely, which in internal rating you don't have. They go to the units, they study their, all the units of the, you concentrate on your own borrower, but they have a visibility on the industry itself. That sort of visibility you don't get in your internal rating. That also you're drawing from an external rating agency. So, and but in internal rating agency, you know the behavior of the account better than the external rating man. Because I know when external rating agency asks for the, how the account is faring, none of the banks give a true picture. There is some sort of a holding out of information there. So both are required as of now. And even when I talk about the post-crisis reforms also, I'll tell you why it is required, because even there it is required. So you can't do away with external rating agency. You will treat it as an unrated exposure, and you will accordingly, give the RWA. And there is one more treatment in the ICAP itself for such accounts, which I will discuss when I talk about the ICAP. So you
Right.
can't go away with it. Better to
Right.
insist, because why is he hiding it will be the question. If he
Okay.
doesn't want to get externally rated, that means there is something that he wants to hide.
Okay, ma'am. Then for calculation of capital charge and risk-based asset, it is up to bank whether it is if it can be done on the basis of internal rating
No,
or
you
external rating.
can't segregate like that. So because you see,
Or
when you take a portfolio and do the PD and arrive at PD, you don't segregate a particular account and say this account I'll keep it out of the portfolio for external rating.
yeah.
That you can't do. You can't no, cherry pick like that.
Right, ma'am. Thank you.
Okay, before I request Mr. Shastri for his observations, there is a question which has come in the chat box. So the question is, ma'am, what are some of the effective measures that a bank can adopt for RWA optimization?
Oh, there are several measures. I can take a session on that. Okay, some of it I can tell you. Like you see, now optimization measures, there you can talk about the mitigants. You can increase the mitigants. That is one way. And you can rebalance your portfolio. Like you can do away with those double B and triple Bs and try to give only, but then again, risk and reward is what I was talking about. So you can't have all, triple A accounts and then do business. But some sort of rebalancing can be done to do some optimization. And the other thing is in the off-balance sheet exposures. So the RWAs, of course, again, I feel like referring to post-crisis reforms where it doesn't matter, but as of now it matters because RWAs, the financial guarantees and the performance guarantees are different. So there some optimization can be done. So like that, there are several. In fact, there were some umpteen number of levers that were given to us to optimize and exercise. That can be done. There are a lot of things like that can be done.
So I think, Mr. Das, your question is answered. Are you on to ask anything more?
There are a lot of things, so he may not be satisfied, but I just gave some hints.
Yes, yes.
Yeah, good
So-
afternoon, Arvind
He
sir.
can talk to me
There is a
separately. I can give him
Just a
some
minute. Huh?
information.
Yes.
In fact, in many of the accounts, what we are seen is that the linking of collaterals is not properly done, especially in case of housing loans, where the risk weight is based on the LTV ratio. The proper security values not being collated in the system, it will have an impact on the RWA. Similarly, in MSME accounts, the availability of CGT-MSG cover is also not captured in many of the accounts. That's what we found. Of course, that was a little longer back. But these things, they help you to reduce the RWA and they can help you. For example, you have banker's account in your books. How much capital you are using for the banker's balance is what you are maintaining. Is there a need? How much maximum capital you can utilize for banker's balances? That way one can drill down to the basics and then see how best you will be able to save on RWAs.
Basically,
Madam, you
look
were
at your
present.
data. Yeah, that's what the data cleansing is very important. These aspects are all coming under, complete data and data cleansing, which makes it complete. So the integrity of data when questioned, the optimization doesn't happen. So that is something, one, focus area which you need to have.
Good, madam. Your presentation is a wonderful presentation. You have nicely explained, especially the way you have linked explained the importance of capital planning. That is seldom overlooked in many instances. And the way you have linked the potential unexpected loss to stress testing, excellent. I have seen how the stress testing impacts the capital planning at a later point in time. We all seen that. You have nicely explained. Congratulations.
Thank you. Thank you.
Thanks, Mr. Shastri.
Thank you, sir.
We
Yeah,
come
Arvind sir.
to Please
good afternoon.
start
Naveen,
your
sir.
video.
Yeah, I'm Indra Roman Kawatra. Good afternoon, ma'am.
Please
I have-
start your video so that I can bring you in the spotlight, and yes,
Yeah,
you
it
can
is
ask
small-
the question. Yes,
Yeah, it is
please.
on from my side.
Right.
Yeah, good afternoon, ma'am.
Good
I
afternoon.
have a very small question related to standardized position for the standardized approach for the operational risk. You were talking about the loss data requirement for that. So loss data which is required, that will be for the how many years? It is for the 3 years or 5 years, or it is only for the 1 year?
Actually, if you have 10 years, that's the best that you can have. But RBI also said, because nobody had, they said that at least have for now, even post-crisis reforms, they're talking about at least have for 3 years. But the
3 years.
longer the number of years of historical data you have, your modeling will be better. The outcome will be better. But that's what 10 years is the best I can say.
Right.
5 years little more better, but 3 years I feel it's insufficient. But RBI is knowing the difficulties of the banks, that they don't have the data. Probably they are compromising to say at least have 3 years. That's my opinion.
Right. Thank you. Thank you.
Okay, thank you, Mr. Quatra. So we come to the end of this session. I think many questions were held back for the next session, and I'm sure we're in the next session we'll have many questions coming. The participants can also send their questions by email so that they can be answered in the next session, or they can be, I think it will be better if we answer in the session, because others who have not asked the question, they will also come to know about the answers of those questions. And friends, I have sent you an email as well as a WhatsApp message giving you the link for giving the feedback on this session. Your feedback is very important for us. It will help us improve in our future webinars and choosing the subject matters, as well as how you felt during this webinar. It will be very important for us to understand that. And now I thank Madam Shashikala, because the session was only 1.5 hours long, but I think she had to prepare for 1 month to take this session. The presentation that she made, it was so thorough and covering everything. It actually involved a lot of work in preparation for taking this session. And I'm thankful to her for having taken the pains and come out with such a beautiful presentation. And I thank you all for having attended this session. And now we come to the end of this session. I thank you all. So namaskar. Thank you.
Thank you.
Thank you.
Thank you, sir.
Thank you, sir.